Welcome to the May 8th, 2023 Advanced Report for McGowan Group clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman, with your weekly fast-paced tour of the global financial markets. What a week it was. I am also President, McGowan Group Wealth Management, a dedicated team of 10 financial professionals and portfolio managers with advanced certifications serving affluent families from the Crescent in Dallas. And this video is designed as an update for our clients, and these charts and graphs prepared by Stephen Norris are proof that we do research, we care about our clients, and we're not boring financial advisors. So if you're a financial advisor, if you're not happy and he's kind of boring and he speaks in complicated terms, well, then it's probably time to go to NetWorthRadio.com, contact us there, set your time for a brainstorming session. Let's see if we can add value to your 2023 plan, hopefully all the way out to 2030 or 40. Now, let's look at this. This is the Fed funds rate. What a week it was. You begin the week with First Republic Bank being taken over and handed to JP Morgan at a $2.6 billion profit. At the end of the week, you had PacWest, and I'll show you some surprises with this, but PacWest, also a venture capital, California-focused bank, they hit the skids. They were down over 75% for the week. And that means they're in hospice like the other three banks that have failed. At the same time on Monday morning that First Republic announced the failure and the takeover by JP Morgan, Janet Yellen on the cover of the Wall Street Journal yelling that the U.S. could default on June 1st. She skipped right over government shutdown or spending control and went straight to shutdown to help the debate from the left side. So those headlines, combined with the highest Fed funds rate, the cost of capital, the overnight bank lending rate is the highest it's been since 2006 and 2007. Wow, that's an ominous sign. Yeah, because you had the real estate collapse and you're seeing bank failures. Is it the same? All four banks were California focused, venture capital, and they had issued a bunch of mortgages at 3%. If you have a mortgage at 3% and you're going to sell it to another bank, well, you have to discount it 20% because new mortgages are 6%. That's called duration risk. Those are the two sources, and notice it's very regional. This is not a nationwide. Back at this time, I was reporting 10 to 15 bank failures a week on the air. So, much different situation because the banks, the bigger banks that are taking these over, FDIC eats a few $billion, tens of billions actually, and the bank that gets it has enough capital to do it, and their stocks have been skyrocketing as a result, meaning the banking system is able to handle this at least for now. So, with all that and the Federal Reserve interest rate increase, well, what happened to the Dow? You would expect a cascade of selling, right? And we would go back to the March lows. But what happened? Yeah, you got a cascade of selling. You could see it right here. It climaxed on Thursday, and then you had a nice little rally on Friday. The Dow was down about 1% for the week. Wow. Instead of making a new low like the March low, 31,400. That's an interesting observation. Why? Because the September 30th low was about 29,000. Wow. So we're making higher lows, and some technicians might call that an uptrend. There's a decision point coming, and we'll get more detailed in future episodes, so be sure to subscribe for fast breaking news. But the market recovered at the end of the week. Why would it be so resilient? Part of the reason is earnings. S&P 500, 85% of the companies have reported 4% sales growth. Not bad. Minus 3% earnings growth. That's the third quarter of an earnings recession, and it happened in 2018 and 19 as well. However, it didn't result in a collapse in the markets because earnings and pricing of the S&P 500 are anticipatory. Earnings are forecast to reach a record level by the end of 2024. And so you can see with the earnings growth, energy's leading the pack at about 20%, industrials, and actually consumer discretionary leading there too. 253,000 net new jobs in the month of April, and consumer discretion companies doing very well. What does that tell you? It's not a recession yet. It's that recession we've been waiting for 9 months, and it's not here, and GDP growth is forecast to actually start rising by the end of the year. All right, this is the 10-year Treasury note. And why would it be at 3.4% if grumpy old Jerome Powell's at 5.25%? Well, some of the institutional buyers of Treasuries think that it's going to be a recession. Other institutional buyers actually do research on the inflation rate, because the Federal Reserve has a thesis that the Fed funds rate has to equal the trailing 12-month inflation rate. That's called the Volcker thesis, getting the 1970s rampant inflation under control, if you will. Here's the monthly inflation number. Whoa, what's that? That's June. That's like 1970s annualizing at 15%, at least for that month. And that took the overall inflation rate to 9%. Well, we don't want Jerome Powell going there, and he shouldn't, because the trailing 12 months measure that the Fed uses is now only 4.2%. It was 9%. That's called disinflation. And when that happened in the early 1980s, you had a huge market rally. Well, look at these numbers. Okay, that's an average of about 0.2. That would be 2.5% annualized inflation. Wow. What happens between here and July? These months drop off. May and June were the third and the first biggest month of inflation, and they drop off the trailing 12 months. By July, you could see inflation just back to normal. That means the Fed would have to head back down. They're saying for now, oh, we're not going to lower. We're going to stay here for a while, and we're data dependent. That means if we change our minds, we're just going to do something else. 16 months of torture on asset values as the comparison base lending rate went up and up and up, values got compressed. Lines of credit at banks are now charging 10%. Wow, yeah, that's going to dampen growth pretty quick. Well, what does that mean? After 16 months of depressing valuations on great assets with real cash flow, we've improved the cash flow, we've improved the quality of the portfolio, we've got great assets at bargain prices. When the Federal Reserve, you get to the good part of the cycle, they start to go back to normal. That's the other prediction that those treasuries are making, that by this time next year, things are headed back towards normal. What's normal? 2 to 3% inflation and the Fed funds rate about there, and maybe a 3 or a 4% on treasuries. What does that do to other assets? It's a potential rally that mirrors 2019. I'm Spencer McGowan, your financial weatherman, president, McGowan Group Wealth Management. Go to networthradio.com, set your time for a brainstorming session. Like the video if you feel that we've added value, and we look forward to having you back next week. Thank you for tuning in to NetWorth Media today, and our efforts over the past 2 decades to educate clients and help clients make great decisions. That's the reason that we're here at YouTube McGowan Group, Apple Podcasts, NetWorth Radio, and networthradio.com. The NetWorth Media effort is designed to help you make great decisions and address value at risk of loss, fluctuation in the markets. Remember, if we talk about a security, doesn't make it a recommendation until you come down and get a plan from McGowan Group Asset Management, the team that cares. You can set a Zoom meeting or an in-office meeting at the Crescent, and we'll give you a written plan that encompasses what we believe to be the best allocations. This is a team of 10 devoted to you. That includes the research that you see each week from Reuters, from Bloomberg, and from the best sources. We always post links at networthradio.com for what we believe can help you make great decisions, the research that comes up. Now, the Net Worth Media effort is also designed to address cycles in the market, value at risk of loss. At networthradio.com, you can get the ADV form that shows, yes, we're a fiduciary, a registered investment advisor. It covers the costs of hiring our team to help you in the future ahead. It really helps to have an expert team on your side that you can reach by phone, email, and of course, a team that's here for you every week to address what's going on in the markets, because anxiety can often lead investors to make decisions that are either dangerous, chasing things, or selling things when they shouldn't. And that's a big part of our planning effort at McGowan Group Asset Management. Thank you for tuning in, and we look forward to serving you and your family in the years ahead.